Hello, and welcome to another Financial Planning Minute. My name is Pat Runyon. In today's video, what I'd like to cover are some of the changes that came along with the tax legislation at the end of year 2022. It's referred to as the Secure Act 2.0, and it was pretty wide-ranging. There were a lot of changes that the bill included that would affect retirement accounts and some other items related to taxes. What I wanted to do today is just highlight three of those changes. This video should not be used as the authority on this because there are a lot of specifics that relate to the laws that we'll talk about as well as your specific situation. But I do think this will be helpful that you are aware of some of these changes. So the first and maybe the most prevalent that people have covered is the required minimum distribution age. So historically, that age was 70 and a half. And what that means is if you have a pre-tax retirement account, once you reach the age of 70 and a half, the government requires you to start taking money out of those accounts. And what that allows them to do is essentially tax those dollars, right? So for years, that was 70 and a half. And a few years back in what we would call Secure Act 1.0, that age was moved to the age of 72. And starting this year through this recent tax law change, that age is now 73. So what this is essentially doing is allowing you to wait longer before you're required to begin taking money out of your retirement accounts. We view this as a good thing. One, because you're not being told when you need to begin withdrawing. And two, it allows for longer deferral periods, which may allow you some more tax planning opportunities in the interim. To give an example, we always look at the years between when somebody retires and required minimum distribution age, which we just said is now 73, as prime Roth conversion time. And what that means is you're likely going to be in a lower taxable income situation in those periods. You may want to accelerate income through Roth conversions and other strategies and take advantage of being in low tax brackets. So the first big change is the fact that required minimum distributions will be 73 starting in 2023. And in fact, they already put on the books that they will move up to 75 in 2033, so 10 years down the road. The second significant change is to catch-up contributions in retirement accounts. And specifically what I'll cover here are to 401ks and other workplace retirement plans. So for years, once you've hit the age of 50, you are allowed to contribute an additional amount, $6,000, $6,500 to a 401k. So they gave you a bit of an advantage being older as you get closer to retirement. Now those amounts will be increased, and those will be increased for specific ages. It will be ages 60, 61, 62, and 63. It'll be increased to $10,000. So they're giving an advantage to people that hit those ages. And then in addition, they are going to require, if you make above what they've stated as $145,000, you will be required to make what are called Roth contributions as your catch-up. So this is the idea: instead of getting a tax break or a tax deduction when you make your contribution, you'll be required to do it as a Roth contribution, which doesn't give you any savings on the upfront, but may allow for further savings down the road when you withdraw. Those savings should be tax-free. So it's kind of indeterminate whether that's a good thing or not for taxpayers. It depends on your personal tax situation, but it's a reality that we're going to be dealing with. The last actually relates to 529s. 529s have been kind of the go-to college savings plan for years. The one knock on them is that they've been a bit inflexible if there's still money remaining. And what the government is now allowing is if the account has been opened and funded for 15 years, you may be able to move proceeds of the 529 directly into a Roth IRA for whoever the named beneficiary is. So if I open a 529 for my son and that account is open for 15 years at some point in the future, I can move what the government is saying is $35,000 over to a Roth IRA for his benefit, and there's no taxable event that takes place. Now, there's some stipulations about how much you can move per year and what the process needs to look like, but long story short, there may be some flexibility and planning opportunities in terms of how you utilize a 529 going forward. So there's many more details in the bill. I would encourage you to look on our website for some of those further details, but I hope this is helpful and look forward to seeing you next time. Thank you.